All right, so the stock market just had its worst day of the year in 2025. $930 billion was just wiped away completely from the US stock market. What are you looking at here? You are looking at JP Morgan, a monster bank. The CEO dumping $233.7 million of their own shares, JP Morgan shares, which was just filed. The one percenters always know when to let go. This is his largest sale ever. Berkshire Hathaway is now sitting at a record amount of cash at $334 billion. And we posted a video 6 days ago. Warren Buffett sold out of his SPY. He sold out of his VU as well. It's not the virus. It's not the wars. This is prevention of bank collapse. China just discovered a new bat coronavirus with the potential to spread to humans. Take a look at the date. Just look at your calendar. Look at the date right now. This right here is February 20th, 2020, when the stock market peaked at an all-time high and then began to sell off. COVID-19 was just being announced. Finally announcing somebody died from it. Announcement of it spreading. The market crashed almost 36%. February 19th into February 20th, 2025, stock market hits an all-time high. The following day, it has had its worst day of the entire year. Let me explain why this all has to do with the largest banks that are around you. The market was already cracking before COVID-19. Before COVID even was a thing, the financial system was flashing warning signs, which we are seeing right now and we have been seeing. Now, there was a repo market crisis. September of 2019, the Fed had to inject liquidity as overnight lending rates spiked. Banks didn't trust each other and were hoarding cash. Federal Reserve balance sheet expansion. The Fed quietly restarted QE, quantitative easing, in late 2019, but didn't call it QE. They knew liquidity was drying up. Corporate debt bubble. Companies were leveraged to the max, borrowing cheap money for buybacks instead of productive growth. Bank of Japan and ECB stress. Foreign banks, especially in Japan and Europe, were heavily reliant on US dollar liquidity through swap lines. Then COVID hit and suddenly everything got blamed on the pandemic instead of real economic cracks that were forming. The Bank of Japan and European banks were facing a serious dollar liquidity crisis before COVID. Why? They borrowed in USD but earned revenue in weaker currencies, i.e. yen, euro. As global growth slowed, they struggled to roll over debt. The Federal Reserve had to expand swap lines to keep these banks from imploding. And then March 2020 rolls around and you see the Fed's emergency lifeline. March 15, 2020, right as the market was crashing, the Fed massively expanded swap lines with central banks. This wasn't about COVID-19. It was about stopping a bank collapse by providing emergency dollar liquidity, which is the same reason why Credit Suisse collapsed in 2023. These cracks were never really fixed. Now, the Fed, Wall Street, they all knew it was coming, and that's why you're seeing JP Morgan sell off. That's why you're seeing Warren Buffett sell off. BlackRock, Goldman Sachs, JP Morgan, these firms shorted the market hard before the crash, and they knew a reckoning was coming. Warren Buffett dumped airline stocks in early 2020 before COVID even got bad. Did he know something? The pandemic narrative became a scapegoat for the collapse, allowing central banks to flood the system with trillions in stimulus while pretending it was about saving the economy. Why it will happen again? Bank of Japan and ECB are still fragile. The same dollar swap problem that happened could happen again. The US Treasury market is illiquid. If foreign banks panic and dump US debt, the Fed will be forced to print money again. The next excuse, we are seeing a brand new pandemic that is just like COVID, a bat coronavirus that can spread to humans very, very quickly. The 2020 crash wasn't just about COVID. It was about a liquidity crisis that was masked as a health emergency, and the Fed used it as an excuse to inject unlimited money into the system. The same setup is brewing again, but this time, more debt, leverage, and the system is more fragile. So what could be coming? And if you haven't liked the video yet, do it right now. The Fed and global central banks control the game. In 2020, the crash was a liquidity crisis masked by COVID. The Fed printed trillions, gave swap lines out to build out Wall Street. The market ripped higher because of free money. They're taking that liquidity away. Right now, however, no more free money equals a market struggle. Markets running on AI hype and leverage, being propped up by a handful of tech stocks, including Nvidia, Microsoft, Apple, Amazon, Google, Meta, and Tesla. Valuations are insane. For example, Nvidia is up over 200% in a year, making the markets look strong. Retail and funds are leveraged to the max. So if AI sees a little bit of a hit, margin calls could easily take place. Bank of Japan and global swap liquidity crisis is happening right now. The Bank of Japan has been keeping rates low to stop their economy from collapsing, but the Fed's high rates are draining global dollar liquidity, making it harder for banks to roll over debt. If the Bank of Japan or major European bank runs into a crisis, the Fed may be forced to intervene again, just like 2020. If the Fed doesn't provide liquidity fast enough, the market crashes hard before a bailout. Now, the US government is issuing record debt, but there aren't enough buyers. If foreign investors, Japan, China, and Europe, stop buying US bonds, interest rates could spike uncontrollably. This could trigger a massive risk-off event like 2008, which would lead to a panic sell-off in stocks as yields spike. Now, if the Fed blinks too late, keeping rates too high for too long, if they wait until the market collapses to cut, it'll be too late. Even if they pivot, the damage might already be done. Sharp crash, Fed emergency response, temporary bounce, reality sets in. Scenario 1, you see a market crash, then the Fed bails it out, which is the more likely scenario. A major liquidity crisis, Bank of Japan, Treasury market, or a big bank failure triggers a sharp market crash from a 20 to 40% drawdown. The Fed and global central banks step in, cutting rates and restarting QE. Market bounces hard, but inflation comes back, leading to a stagflationary environment, which has been warned about based on the Fed's moves over the past couple of years. Scenario 2, Fed cuts early, markets get one more blow off top before the real crash, which would lead to a bigger crash in 2026 than a 20 to 40% drawdown. You guys see what's happening here? Here we go again. Here we go again. This was posted by Roaring Kitty March 24th of 2021. Greg just posted this picture with the coronavirus. I mean, the tin is just too coincidental. We're also seeing Bybit just getting hacked. People are saying that they're potentially insolvent, which also leads to Fort Knox about to get audited by Doge to see if there's actually gold in there. And you're seeing Swiss gold imports to the US spike to all-time highs. They're trying to put gold back in there before they get audited. I mean, shit's hitting the fan, and you're seeing it unroll in real time, right? The people who aren't paying attention aren't ready, and we could have seen a potential top on the market. We also seen another institution add more shares to GameStop. Now I want to move on to a couple other things. Elon is doing a great job, but I would like to see him get more aggressive. According to Trump, basically Doge is doing a great job. They saved a lot of money, but Trump says there is a lot more money to be saved. We saved about 55 billion, but there's up to 2 trillion or more to be saved. Now, Microsoft-backed OpenAI is pushing ahead with its plan to reduce reliance on Nvidia, which brings us into Nvidia. Nvidia has earnings this week, Wednesday, February 26th. If we look at Nvidia's valuation, the trailing 12-month price to earnings ratio is at a 52, almost 53, which most stocks trade at a 20 to 28. Forward PE 33, most stocks trading 18 to 26. 2-year forward PE 33 again. Their trailing 12-month earnings per share growth 234%. Many stocks trading at 8 to 12%. I mean, the company, the AI bubble, everything is overvalued. Even if people don't want to tell you it's overvalued, the hype is in. And if the bubble pops, it's going to pop hard. And Nvidia does have earnings this week, which could shine light on a few things. I originally thought Nvidia was going to gap higher on earnings based off of historical patterns with the stock. However, if we're looking at a more macro perspective, if the market has built the top in, Nvidia is going to lead the way with a large gap lower. Okay, there's a lot of other earnings plays this week. I'll touch briefly on HIMS. This is reporting Monday, February 24th. So as soon as the market opens, this will be interesting because the stock is very up there in valuation. We're trading at a 12-month price to earnings ratio of 114. Overall, the stock does look good, but is it super overvalued because of the hype? Yes, likely. But they did get a major beat on their recent earnings, and their expectations for this earnings coming up on Monday isn't actually as high as you'd like to think, right? They killed it last earnings, but now their expectations weren't even moved up by that much. So if they beat again like this, then HIMS could just have another gap higher and have shorts cover out of it again. Palantir, 101.35. This stock is really looking to break down. We are seeing a trailing 12-month price to earnings at 533, which is just, the company's overvaluation is just disgusting on Palantir, given it's a great company, it has a lot of potential, but I think as of right now, at this point, I don't care how long it takes, you're likely to see a pullback at minimum to 91 bucks, but likely to $84, 83, $84, right? At minimum, 91 to $84, maybe even lower, especially if the market crashes. Tempest AI also reports on Monday, trading at $68, down 11% on Friday. This one could blow earnings out of the water, or maybe it misses earnings, right? Either way, this is definitely one that I will be watching as well. We recently did enter price discovery, but immediately got rejected. People realizing that the stock is not a stock that is ready to go. and it's an overvalued company that maybe a lot of people aren't going to want to hang on to, and it had a lot of the Nancy Pelosi hype behind it. Overall, guys, let me know your thoughts in the comments down below. Make sure to go watch my other videos. Press the top link in the description to join my Discord server where we talk stocks and crypto all day long. We also just added a short squeeze channel in there. I also post my trades as soon as I enter them on the daily. I give you guys trade setups. We talk with the most amazing people. There are no bad questions. I don't care if you just started trading yesterday or you've been trading for 20 years now. Just get in the Discord server. You guys will not regret it. We also have a ton of other benefits that pay for themselves, like high success trade flow alerts, AI bots that send off alerts for insider trades, dark pool alerts, market news, analyst grade updates, and more. So get in there. And the second link in the description is for a free broker. I'm partnering with Moomoo so that when you sign up using my link, you're getting up to 30 free stocks after you make a deposit into your broker account. And they're giving you 8.1% APY on your uninvested cash, access to level 2 order book data for free, trading options, going long, going short, viewing other exchanges, and more as a retail trader. So go do that, guys. Do not sleep on it. That is it. Enjoy the rest of your weekend. I love you all. God bless. Lottery Stocks out.